The word mortgage comes from the French language. It is built from two roots, mort and gage. Mort means death, gage means pledge. Put them together, and the word mortgage translates directly into English as death pledge, a pledge that lasts until you either pay it off completely or you die. That is not a metaphor. That is the literal etymology of the word you sign when you buy a house. The very language of the contract tells you exactly what you are agreeing to, and almost nobody notices. Right now, approximately 65% of American households own a home. That number is treated as a sign of prosperity, of progress, of the American dream made real. But if you look beneath the surface of that statistic, most of those homeowners are still paying off a mortgage. They owe money on the house they call theirs. They have a death pledge attached to the most important asset of their lives. And the system that created that pledge was not designed to give you a home. It was designed to give a bank 30 years of guaranteed income from your labor. This is not a housing story. This is a control story. And it starts with understanding what homeownership looked like before the system was re-engineered to serve the lending industry. Before 1930, buying a house in America was a fundamentally different transaction. It was not a 30-year commitment. It was not a financial product. It was a purchase. A family would save money over several years. They would accumulate enough to put down 50% or more on a property. The remaining balance, if any existed, was paid off within 3 to 5 years through a short-term loan from a local bank or even a private lender. The process was slow. It required patience. It required discipline. But the end result was real ownership. When the final payment was made, the house belonged to the family. Completely. No liens, no monthly obligations, no institution with a legal claim on their most valuable possession. Homeownership was a destination, something you arrived at after years of saving and planning. It was not something you were rushed into at 25 years old with almost no money down. Then the Great Depression hit, and everything changed. In the early 1930s, the housing market collapsed along with everything else. Banks failed, property values cratered, millions of families lost their homes. The federal government under President Franklin Roosevelt needed to stimulate the economy and stabilize the housing sector. In 1934, they created the Federal Housing Administration, or the FHA. The stated purpose was to make homeownership accessible to more Americans, to lower the barrier of entry, to let families buy homes without needing massive savings up front. And on the surface, that sounds like a noble goal. Who could argue against making it easier for people to own a home? But look at what the FHA actually created. It did not just lower down payments. It standardized the 30-year fixed-rate mortgage as the primary vehicle for home purchases in the United States. It guaranteed loans to banks, meaning that if a borrower defaulted, the federal government would cover the loss. The banks carried almost no risk. The borrower carried all of it. The 30-year timeline was not chosen randomly. It was chosen deliberately. And the reason it was chosen is because 30 years represents the most productive working years of an average American life. You typically enter the workforce in your early 20s. A 30-year mortgage locks you into that system until you are in your 50s or beyond. You cannot quit your job. You cannot move to another city without consequence. You cannot start a business that might fail because failure means missing a payment. You could not do anything that threatens your income because your income is no longer just supporting your life. It is servicing a debt that a bank holds a legal claim over. The system did not make homeownership easier. It made lifelong debt easier, and it made it feel normal. Now, let us talk about the mathematics, because this is where the trap becomes inescapable. Imagine you buy a house for $400,000. You put down 10%, which is $40,000. You finance the remaining $360,000 through a 30-year mortgage at a 6% interest rate. Your monthly payment comes out to approximately $2,159. That number feels manageable. $2,000 a month for a house? Reasonable? Affordable? Worth it. But here's what nobody shows you at the closing table. Over the life of that 30-year loan, you will make a total of 360 monthly payments. Multiply $2,159 by 360 months. The total amount you will pay the bank is $777,000. You bought a $400,000 house, you will pay the bank $777,000. You are paying the bank nearly double the value of the property. The bank collects $400,000 in interest on top of the original loan amount. $400,000 for doing nothing except holding a piece of paper and collecting your payment every month. But the mathematics get worse when you look at the early years of the loan. This is where the amortization schedule reveals the true structure of the system. In the first year of your 30-year mortgage, you make 12 monthly payments totaling approximately $25,900. Of that amount, roughly $21,000 goes directly to the bank as interest. Only $4,900 reduces your actual loan balance. Read that again. In the first year, 80% of everything you pay goes to the bank as profit. Only 20% goes toward actually owning more of your home. By year 5, the ratio is barely shifted. By year 10, you have made 120 payments. You have handed the bank approximately $259,000, and your remaining loan balance is still roughly $309,000. You have paid $259,000, and you have reduced your debt by $51,000. You have been paying your mortgage for a decade. You have made 120 payments, and you still owe 86% of the original loan. The bank owns your house for the first 20 years. You are not a homeowner. You are a tenant who happens to have a piece of paper with your name on it. This structure is called front-loading. The amortization schedule is mathematically engineered so that interest is collected first and principal is paid last. It is not an accident of calculation. It is a deliberate design choice that maximizes the bank's return in the early years of the loan, which are also the years when the borrower is most locked into the arrangement. And here is the final layer of the trap. If you move after 7 years, which is the average length Americans keep a home before selling, you have paid approximately $168,000 in mortgage payments. Of that amount, roughly $135,000 went to interest. You have reduced your principal by only $33,000. You sell the house, pay real estate commissions, and walk away with barely more equity than your original down payment. You lived in that house for 7 years. You paid $168,000, and you built almost no wealth. The system is not broken. The system is working exactly as it was designed to work. Now let us discuss what this does to a person beyond the mathematics. Because the mortgage does not just affect your finances. It restructures your entire life. Think about what a 30-year debt obligation does to a person psychologically. You have a payment due on the 1st of every month. Every single month for 3 decades. Miss 1 payment and your credit score drops. Miss 2 and the bank begins foreclosure proceedings. Miss enough and you lose everything, including the down payment you spent years saving. This creates a state of permanent financial vulnerability. And permanent financial vulnerability creates permanent behavioral compliance. A person with a 30-year mortgage cannot afford to say no to their employer. They cannot afford to walk away from a job they hate, a boss who mistreats them, or a workplace that underpays them. Because walking away means no income. No income means no payment. No payment means the death pledge activates. A person with a mortgage cannot take risks, cannot start a business that might fail, cannot invest in something uncertain, cannot spend 2 years building something new because the monthly obligation will not pause while they figure out their next move. The mortgage does not just bind your finances to a bank. It binds your decisions, your career, your relationships, and your sense of security to a 30-year obligation that was created by a government program designed in the 1930s to give banks a reliable revenue stream. This is the new serfdom. In medieval Europe, a serf was bound to the land they worked. They could not leave. They could not refuse to labor. They worked the Lord's fields for generations, producing wealth that flowed upward while they remained in place. The land was not theirs. It belonged to the Lord. They simply lived on it and worked it until they died. Replace the Lord with a bank. Replace the land with a mortgaged house. Replace the feudal obligation with a 30-year payment schedule. The structure is identical. You live in a home that does not truly belong to you. You work a job not entirely because you choose to, but because you must. Your labor produces wealth, a portion of which flows upward to an institution that holds a legal claim on the place you sleep at night. The serf did not choose servitude. They were born into it. The modern mortgage holder does not choose debt slavery either. They are born into a system where 30 years of borrowing is presented as the only realistic path to having a roof over their head. By the time they understand the mathematics, the contract is already signed. Now let us address the question that every person watching this video is probably asking. So what do you actually do? The first and most important step is to recognize what a mortgage actually is before you sign one. It is not a gift. It is not a shortcut to wealth. It is a financial instrument designed to generate profit for a lending institution over the longest possible period of time. Knowing this does not mean you should never buy a home. It means you should buy one with your eyes open. The second step is to shrink the timeline. A 30-year mortgage is the most expensive version of this product. A 15-year mortgage at the same interest rate cuts your total interest paid by more than half. Your monthly payment is higher, yes, but your total cost drops dramatically. If you can afford a 15-year payment, you should never take a 30-year loan. The third step is to increase your down payment as much as humanly possible. Every dollar you put down up front is a dollar the bank cannot charge you interest on for 30 years. A larger down payment means a smaller loan. A smaller loan means less total interest. Less interest means more of your labor goes toward building your own wealth instead of the bank's balance sheet. The fourth step is to make extra principal payments whenever you can. Even small amounts paid toward principal early in the loan dramatically reduce the total interest you will pay over the life of the mortgage. An extra $200 per month toward principal on a 30-year loan can shave years off the total timeline and save tens of thousands in interest. And the fifth step is to understand that the goal is not home ownership. The goal is ownership, full, unencumbered ownership, a home with no mortgage attached. A place that belongs to you completely, not to a bank, not to a lender, to you. Real wealth is not a property with your name on a document that also has a bank's lien attached to it. Real wealth is a property with your name on a document and nothing else. Real freedom is not permission from a bank to live in a house. Real freedom is having no bank involved in your housing at all. The word mortgage means death pledge. The system was built to keep you paying until you either finish or you die. But there's a third option. You understand the mechanism before you enter it. You make the math work in your favor instead of the bank's. And you build a life that does not depend on 30 years of compliance to a system that was never designed to serve you. The doors are still open, but this time you know exactly what is on the other side. Here is what I need you to do right now. Go to the comments. Calculate how much total money you will pay the bank over the life of your mortgage. Not the house price, the total amount including interest. Write that number down. And if you are debt-free, if you own your home outright, write this in the comments. I'm not a tenant. I want to see how many of you are actually free.